Let me ask you something. Think back to the last time you felt genuinely anxious about money. Maybe it was opening your banking app and seeing a number you weren't expecting. Maybe it was a conversation with a partner about where all the money went this month. Or maybe it was just that quiet, low level hum of dread that sits in the background when you know deep down that things aren't quite adding up. That feeling is so common, it's almost universal. And yet, somehow, we grew up in a world that taught us quadratic equations, the causes of the First World War, the phases of mitosis, and said absolutely nothing about how money actually works. Not a word about interest rates, not a single lesson on how to read a paycheck, no class called How Not to Be Broke at 35 while technically earning a decent salary. And here's the part that really gets me. It's not that these things are complicated, they're not. The basics of personal finance, the stuff that would genuinely change most people's lives, it fits in a single conversation. One honest, calm, human conversation. That's what this is. I'm Lucy, and I spend a probably unhealthy amount of time studying how people live with money. Not how they invest it, but how it quietly decides what they feel allowed to do. Most adults aren't bad with money, they were just never given the rules. In this video, I'll show you the simple ones that change everything. And if you want a calm place to keep learning them, you can subscribe. Before we get into any of the actual content, I want to reframe something, because I think most financial content gets this completely wrong. The story we're usually told about money goes something like this. If you're struggling financially, it's because you lack discipline. You spend too much on coffee. You make impulsive decisions. You just need to try harder, budget better, want it more. And look, behavior matters. Of course it does. But that story leaves out something enormous. It leaves out the fact that we were never taught any of this. Not really. And then the systems we live inside, the way credit works, the way retail is designed, the way subscriptions auto-renew, the way car dealerships frame purchases around monthly payments instead of total cost, all of it is specifically engineered to work against your instincts. So if you feel behind or confused, or like everyone else somehow got a manual for adult life that you never received, that's not a character flaw. That's an entirely rational response to being dropped into a financially complex world with no map. What I want to do today is give you the map, not in a way that's preachy, not in a way that assumes you have a lot of money to work with right now, just clearly, honestly, in a way that actually makes sense for real life. We're going to cover 6 things: where you actually stand right now financially, how to build a budget that doesn't make you miserable, how emergency funds actually work and why they matter more than anything else, how to think about debt strategically instead of just dreading it, the basics of investing, which are much simpler than anyone makes them sound, and a few thoughts on the big decisions: buying versus renting, cars, retirement, the things that shape your financial life more than almost anything else. By the end, my hope isn't that you feel fired up and ready to change your life overnight. My hope is that you feel calmer, clearer, less like money is this intimidating thing happening to you, and more like it's something you understand and can actually work with. Let's start at the beginning. The single most disorienting thing about personal finance is that most people are navigating without knowing their starting point. Imagine trying to drive somewhere without knowing where you are right now. That's what managing money feels like when you don't have a clear picture of your actual financial situation. You're just kind of moving and hoping. So the first thing I want you to understand is a concept called net worth, and I want you to strip away any emotional charge around that phrase, because people hear net worth and they think it's something only rich people think about. It's not. It's just a number, your number, and knowing it changes things. Net worth is simple. Take everything you own that has financial value, your savings account, your checking account, any retirement accounts, a car if you have one, investments if you have them. Add all of that up. Then take everything you owe, credit card balances, student loans, a car loan, any other debt. Subtract that second number from the first. That's your net worth. It might be positive. It might be zero. It might be negative, which is where a lot of young people are, especially anyone who's been through college with loans. And all of those scenarios are okay, because right now we're just measuring. We're not judging. Here's some context that might help. According to data from the Federal Reserve, the median net worth for people under 35 is around $39,000. That means half of all households in that age group have a net worth below $39,000. For households between 35 and 44, the median is roughly $135,000. These numbers aren't meant to make you feel behind or ahead, they're just landmarks, a way of understanding where the average person sits. The second number I want you to understand is your monthly cash flow. This is the difference between what comes in every month and what goes out. Income minus expenses. Now, most people have a rough sense of their income, but expenses is where things get genuinely surprising, because there's the spending you consciously think about, rent, groceries, utilities, and then there's all the spending that happens kind of automatically. Subscriptions, convenience purchases, the way food costs drift upward over a few months without you really noticing, the impulse buys that feel small in the moment. If you have never actually tracked your spending for a full month, I'd encourage you to try it just once, not to punish yourself, just to see, because what you find is almost always different from what you expected. People consistently underestimate their spending, not because they're irresponsible, but because they're not keeping score. Your cash flow tells you something crucial. Are you gaining ground every month, treading water, or slowly falling behind? If your income is $4,000 and your expenses are $3,700, that $300 surplus is the raw material of your financial progress. Small, yes, but not meaningless. $300 a month invested consistently over 30 years at a reasonable market return grows into something that would genuinely stun most people. The third number I'd call your runway, how many months you could cover your expenses if your income stopped tomorrow. Take your liquid savings, the money you can actually access without penalty, and divide it by your monthly expenses. If you have $6,000 saved and your monthly expenses are $3,000, you have 2 months of runway. That's 2 months of time and options if something goes wrong. The reason this matters isn't just practical, it's psychological. People who have even a small financial buffer make better decisions. They're less likely to take a bad job out of desperation, less likely to make expensive decisions because they feel trapped. Even 1 month of runway creates a kind of quiet confidence in your financial decision-making that's hard to put a value on. So before you do anything else, figure out these 3 numbers: net worth, monthly cash flow, runway. Write them down. They're your starting point. Let's talk about budgeting. And let's be honest up front, the word itself carries a lot of weight. For a lot of people, budget conjures images of restriction and deprivation, of tracking every dollar spent on lunch and feeling guilty about it. And because that version of budgeting feels miserable, most people try it for 2 or 3 weeks and then quietly abandon it. But I'd invite you to think about a budget differently. A budget isn't a restriction, it's a decision about what you care about. Every month, you have a certain amount of money, and that money is going to go somewhere. The question isn't whether you'll spend it. The question is whether you'll decide in advance where it goes, or whether you'll figure out where it went in retrospect. A budget is just choosing in advance. That's it. The most important thing I can tell you about budgeting is this. The best budget is the one you'll actually use, not the most rigorous one, not the most optimized one, the one that fits your life and that you can sustain for months and years, not just weeks. There's a framework called the 50-30-20 rule that a lot of people find useful as a starting point. The idea is that roughly 50% of your after-tax income goes towards needs: housing, food, transportation, utilities, the things that keep your life running. Around 30% goes towards wants, things you enjoy but don't strictly need, and 20% goes towards savings, investments, or paying down debt. Now, those percentages aren't sacred. If you live in a city with high rent, your housing costs might already consume 40% of your income, and that's okay. The framework isn't a rule you have to follow exactly. It's a lens that helps you see where your money is going and whether the proportions feel right. There's another approach called zero-based budgeting, where every dollar that comes in gets assigned to a specific purpose before the month begins. Income minus all your allocations, savings, bills, spending categories, should equal zero. Not because you spend everything, but because nothing is left unaccounted for. This approach takes more effort, but for people who like to feel in control of their money, it's genuinely powerful. Regardless of which approach you take, there are two things that derail most budgets. The first is forgetting about irregular expenses, things like car registration, annual insurance payments, holiday gifts, or a dental bill. These don't happen every month, so people leave them out of the monthly budget. Then one of them hits, and suddenly that month feels like a disaster. The solution is simple. Estimate your annual total for these irregular expenses, divide by 12, and set that amount aside each month. You're smoothing out the timeline, so nothing catches you off guard. The second thing that derails budgets is not leaving room for actual life. A budget that doesn't include anything for entertainment, eating out, or doing the things you enjoy is a budget that will eventually collapse. You are not a robot optimizing for maximum financial efficiency. You're a person, and people need to experience some joy in their daily lives. Build that in. Even if it's a small amount, give yourself permission to spend on things you enjoy without guilt. It makes the whole system sustainable. One more thought on budgets. Revisit them. Your life changes, your income changes, your expenses change. A budget you set up when you were renting a studio apartment won't work when you have a family and a mortgage. Treat your budget like a living document, not a set of permanent rules carved in stone. Here's something I genuinely believe. If I could give one financial tool to every person who feels financially anxious, it wouldn't be an investment account. It wouldn't be a complex debt repayment strategy. It would be an emergency fund. Not because it earns money, it barely does, but because of what it does to your psychology. When you have no financial cushion, every unexpected expense becomes a crisis. Your car needs a repair, a medical bill arrives, your landlord raises the rent, and you need to find a new place, which means first month, last month, and a deposit up front. Without savings, any one of these things can send you into debt. And then the debt creates a new kind of pressure that makes the next unexpected expense even harder to absorb. The traditional advice says you need 3 to 6 months of expenses saved as an emergency fund. That's real and valid, but I understand that for a lot of people, hearing that number feels discouraging rather than motivating. If your monthly expenses are $3,000 and you're living paycheck to paycheck, saving $9,000 to $18,000 feels essentially impossible. So let's make it concrete and smaller. Start with a goal of $1,000. That's it. Just $1,000 sitting in an account you don't touch unless something genuinely goes wrong. That $1,000 won't cover a major medical crisis, but it will cover a car repair, an unexpected bill, a gap between paychecks when something shifts. It changes the math of your life in a real way. Put this money in a high-yield savings account, not your regular checking account. The reasons are twofold. First, online savings accounts at reputable banks often pay meaningfully more interest than traditional savings accounts. Not life-changing amounts, but better than nothing. Second, and more importantly, keeping your emergency fund separate from your everyday spending money creates a psychological barrier. It's there when you need it. It's not there to be quietly dipped into for things that feel urgent in the moment but aren't true emergencies. Automate the contributions. Even if it's $25 a week, set up an automatic transfer from your checking account every payday. Treat it like a bill that gets paid before anything else. Because left to willpower alone, most of us will find other uses for that money before we remember to save it. And here's something worth sitting with. The point of an emergency fund isn't just financial, it's emotional. Having that cushion, even a small one, genuinely changes how you experience financial stress. The low-level anxiety of what happens if something goes wrong gets quieter, and quieter anxiety means clearer thinking, which means better decisions. The emergency fund pays dividends that don't show up in any spreadsheet. Once you've hit that initial $1,000, keep building. Gradually, over time, work toward 1 month,
then 3 months, then 6 months. Your target number should reflect your specific situation, how stable your income is, how many people depend on you financially, how quickly you could find new work if you lost your job. Someone with a stable salary and a working partner might be fine with 3 months. Someone self-employed with a variable income might genuinely need closer to a year. Most of us have some relationship with debt, and the way we feel about it is usually somewhere between low-grade shame and active avoidance. Like, if we don't look directly at the numbers, maybe they won't feel as real. But debt, like most things in personal finance, becomes much less scary when you actually understand it. So let's look at it clearly. The first thing to understand is that not all debt is the same. Some debt is in a real sense neutral or even useful. A mortgage on a home you can afford, for instance, lets you build equity over time in an asset that might appreciate. Student loans, if they lead to meaningfully higher earning potential, can be a reasonable trade. These aren't universally good, but they're not the same thing as charging a vacation to a credit card at 22% interest.
High-interest consumer debt, credit cards especially, is a completely different category. This is the kind of debt that compounds against you in the same way that investments compound for you. If you carry a $5,000 balance on a card charging 20% interest and you only make minimum payments, the math becomes genuinely alarming. You'll pay back far more than you borrowed, and you'll be paying it back for years. The interest on that debt is money that isn't building your future. It's just gone. So if you have high-interest debt, that is your financial priority. More urgent than investing, more urgent than building savings beyond your initial emergency fund cushion. The guaranteed return you get by eliminating a 20% interest rate is better than any investment you're likely to find. There are two main strategies for paying off debt, and they both work. They just work in different ways psychologically. The first is called the debt avalanche. You list all your debts by interest rate and attack the highest interest debt first, while making minimum payments on everything else. Once the highest rate debt is paid off, you roll that payment toward the next highest, and so on. Mathematically, this is the most efficient approach. You pay the least total interest overall. The second is called the debt snowball. You list your debts by balance, smallest to largest, and pay off the smallest balance first, regardless of interest rate. This doesn't optimize for math, but it optimizes for something equally important: momentum. Paying off a debt entirely, even a small one, provides a psychological win that can sustain your motivation through what is genuinely a long and sometimes discouraging process. Neither approach is universally right. If you're someone who can stay disciplined over a long stretch without needing visible wins, the avalanche saves you more money. If you've tried before and motivation has been the problem, the snowball might actually get you further, even if it costs a little more in interest. What matters more than which method you choose is consistency, and also this: understanding why the debt accumulated in the first place. Because paying off debt while leaving the underlying patterns untouched often leads back to the same place. Debt is frequently a symptom of something: an emergency fund that didn't exist, a period of income disruption, lifestyle creep that outpaced income growth, or emotional spending patterns that were never examined. The debt payoff is the surface work. The deeper work is understanding what you do differently next time. For student loans specifically, if you have federal loans, understand your repayment options before defaulting to the standard plan. Income-driven repayment options can meaningfully reduce monthly payments, and certain loan forgiveness programs exist for people working in public service or nonprofit sectors. These programs have strict requirements, and navigating them matters because small administrative errors can disqualify years of qualifying payments. It's worth understanding your options carefully, rather than just setting a payment and forgetting it. I want to pause here for a moment because there's a shift I want you to notice in how we've been talking about all of this. Everything we've covered so far, net worth, budgeting, emergency funds, and debt, these aren't really about money at the deepest level. They're about reducing the amount of your mental energy that money consumes. Because here's what financial stress actually does to people: it narrows your thinking.
When you're worried about covering rent, a part of your brain is always running in the background on that problem. You make decisions from a place of scarcity and urgency rather than clarity. You take the job that pays more, even if it's bad for you. You can't say no to things you should say no to. You can't say yes to things that could change your life. Financial literacy isn't about becoming obsessed with money. It's about getting money to take up less space in your head. That's the actual goal. A life where you're not constantly anxious about the numbers, where you have some cushion against the unexpected, where your spending reflects what you actually value rather than just what happened. That shift from money as a source of dread to money as a tool you understand is a real change, and it's available to almost anyone. Not overnight, not without effort, but it's there. All right, let's talk about investing. And I want to be upfront about something. Investing is the area of personal finance where investing is most likely to be used against you. There's an entire industry built around making investing seem complicated enough that you'll pay someone to do it for you. A lot of the time, that complexity is manufactured. The core idea is genuinely simple. When you invest, you're putting money into something, usually a collection of companies through the stock market, with the expectation that those companies will grow in value over time. You're being patient. You're trusting that the economy, on a long enough timeline, trends upward, and you're letting that growth compound. Compound growth is the concept that makes investing transformative over long periods. When your investments grow, you then earn returns on those returns. Over decades, this creates an acceleration effect that's genuinely remarkable. The classic illustration: $100 per month invested at 8% annual returns starting at age 25 becomes roughly $700,000 by age 65. Start the same contribution at 35 and you end up with around $300,000. Same total contributed. That $400,000 difference comes almost entirely from time. This is why the most important investment decision you'll ever make isn't which fund to pick or when the market is going to do what. It's when you start. The earlier, the better. And earlier, for most people, means now. Where should you actually put your money? For someone starting out, the answer is genuinely simple: low-cost index funds. An index fund is a fund that tracks a broad market index, like the S&P 500, which represents 500 of the largest companies in the United States. Instead of trying to pick winning companies, you just own a tiny slice of all of them. When the overall economy grows, your investment grows. You're not betting on any single company. You're betting on the general trajectory of human economic activity, which over long periods has been consistently upward. These funds have very low fees, which matters more than most people realize. A fund that charges 1% annually takes substantially more of your wealth over decades than a fund that charges 0.05%. It seems like a small difference, but compounded over 30 years on a large portfolio, the gap is significant. The next question is where to hold these investments. If your employer offers a retirement plan with matching contributions, a 401k is the most common in the US, start there. Employer matching is the closest thing to free money that exists in finance. If your employer matches 50% of contributions up to 4% of your salary and you don't contribute enough to capture that full match, you're declining part of your compensation. Do that first and foremost. After capturing your employer match, consider a Roth IRA if you're eligible. With a Roth, you contribute money that's already been taxed, and then it grows tax-free. When you withdraw in retirement, you pay no taxes on those withdrawals, including all the growth. For people who are younger and likely in a lower tax bracket now than they'll be later, this is usually a very favorable arrangement.
One thing I want to address directly: market crashes. Because if you're going to invest in stocks, you will experience market downturns. This is not a possibility, it is a certainty. At some point, you will watch your account balance drop by 20 or 30% or more, and you will feel the very strong urge to do something about it. The most important thing I can tell you about market downturns is this: for long-term investors, they're temporary.
Every significant market decline in history has eventually recovered, and while no one can promise that will always be true, the consistent pattern over more than a century of market data is that patient investors are eventually rewarded. When the market falls, your regular contributions are buying more shares at lower prices. When the market recovers, those extra shares are worth more. This is the mechanical advantage of investing consistently through all market conditions. It's called dollar cost averaging, and it works precisely because it removes the temptation to time the market. The investors who do worst in downturns are the ones who sell at the bottom. The ones who do best are the ones who hold on, keep contributing, and wait. That takes emotional discipline, but it's the closest thing to a guaranteed path to long-term wealth building that exists for ordinary people. Let's spend a few minutes on the decisions that tend to have the biggest impact on your financial life, not because of what you choose, but because of what you're willing to examine honestly. The first is housing. The cultural script says renting is throwing money away, and owning is the path to financial stability. Reality is more nuanced. Homeownership can absolutely build wealth over time, but only under specific conditions. You buy at a reasonable price relative to local rents, you can afford the full costs of ownership without financial strain, and you stay long enough for the transaction costs to make sense, which is typically 5 to 7 years at minimum. The full cost of owning a home goes well beyond the mortgage payment. Property taxes, homeowners insurance, maintenance. The general rule is to budget around 1 to 2% of the home's value per year for upkeep, and for older homes, it can be more. When you add all of that up, renting can sometimes be genuinely the more financially sound choice, especially in expensive cities where buying requires a debt load that consumes most of your cash flow. The rent versus buy decision is one of the most personal in personal finance because it involves factors beyond the financial: how long you plan to stay, how much stability you want, whether you want flexibility. Both options can be financially sound. What matters is making the choice deliberately, with full awareness of the costs, rather than because renting feels like failure. The second big decision involves transportation. This is an area where small choices compound quietly in the background for years. The average new car payment in the US has climbed above $700 per month. Add insurance, fuel, maintenance, and depreciation, and the total cost of car ownership can easily exceed $1,000 per month. Over years, that is an enormous amount of money redirected away from your financial future. I'm not going to tell you to never buy a car or to live without one if you genuinely need one. Context matters, but I'd encourage you to ask an honest question. Is the car you're driving or considering driving a decision based on what you genuinely need, or is it a decision based on what feels normal or expected? There's a meaningful difference between those. A reliable used vehicle bought with cash or financed conservatively over a short term gets you from one place to another just as effectively as a newer, more expensive one. The financial difference over a decade can be substantial enough to meaningfully change your retirement timeline. Retirement is the third big decision area, and it's the one most people defer longest for understandable reasons. It feels distant. The trade-off between spending today and saving for a future that seems abstract is psychologically difficult, but the math makes the case better than any argument I could offer. Time is the primary input in building retirement wealth. The money you invest at 25 has 40 years to compound. The money you invest at 45 has 20. Those extra 2 decades don't just add linearly, they compound. The difference between starting at 25 versus 35 with the same monthly contribution can be easily hundreds of thousands of dollars. You don't need to have it all figured out. You don't need to contribute massive amounts immediately. Start with something. If your employer matches contributions, contribute at least enough to capture the full match. If you can contribute more, contribute more. Increase your contribution rate by even 1% when you get a raise. These small, consistent adjustments compound over time in ways that are hard to fully appreciate until you see the numbers decades later. So what does any of this actually look like in practice? Not in some theoretical perfect scenario, but in a real life with real constraints. It looks like this. You spend an hour this week actually calculating your net worth, your monthly cash flow, and your runway. You write the numbers down. You acknowledge where you are without judgment because judgment doesn't help and accuracy does. You open a high-yield savings account if you don't have one. You set up an automatic transfer. Whatever amount won't cause your checking account to bounce, even if it's small, to start building a cash cushion. You leave it alone. You look at your debt. You list it. You make a decision about which approach fits your personality, and you start. Minimum payments on everything, extra money on one target, consistent, every month. If your employer offers retirement matching and you're not contributing enough to get it, you fix that. Even if the contribution amount feels uncomfortable, the match makes it net positive immediately. You choose one budgeting approach, whichever one feels least miserable to you, and you try it for 90 days. Not forever, just 90 days. Then you evaluate. What worked? What didn't? You adjust. And then you repeat, month after month, year after year. The thing about personal finance is that it rewards consistency far more than brilliance. You don't need to make perfect decisions. You need to make decent decisions repeatedly for a long time. The compound effect works on behavior just like it works on money. I want to end with something that I think often gets lost in conversations about money. Financial progress is not linear. There will be months where something goes sideways and you dip into savings you were proud of. There will be years where the market drops and accounts you've carefully built look smaller than they did before. There will be periods of life, a job loss, a health crisis, a family situation, where financial progress just isn't possible and survival is the goal. None of that means you failed. None of that undoes the foundation you've been building. The fact that you watched this video, that you're thinking about these things at all, puts you in a different relationship with your finances than you were an hour ago. That's not nothing. Understanding something changes how you move through it, even before the circumstances change. You are not behind beyond the recovery. You are not too late. The compounding power of time is real, and you still have time. The question is just what you do with it from here. Progress beats perfection every single time. A small amount saved consistently beats a large amount saved sporadically. A budget that works most of the time beats one that's theoretically perfect but abandoned after a month. A retirement contribution that starts now beats one that starts later with more conviction. Start where you are. Use what you have. Do what you can. That's always been enough to build something real. Before you go, take 10 seconds. Think about one money habit you've been avoiding, not fixing, just avoiding. That's usually where understanding begins. If this helped you see it a little clearer, you can subscribe, and I'll meet you in the next one.